Hello, welcome to Part A of our final exam review. Part A is focused on making sure that you understand the concepts, definitions, and formulas in all of the sections that will be covered on the final exam. It consists of a series of short overviews by handout. Part B of our review is going to be more tactically focused, and in Part B, I'm going to go through with you tips on how to handle a Proctorio-based exam and give you some insight into the types of particular problems you may or may not see on the final. Okay, with all that in our pocket and without any further ado, let's get started with Part A with Chapter and Handout 13A. Okay, so the first thing you'll notice here is that I'm not starting with handout 12. Handout 12 is really just a review of probability and statistics, and handout 13a is where we start applying probability and statistics to finance problems. So that's where I'm going to jump in. So 13a is about introducing probabilistic risk models for us. In general, the idea here is that we're trying to use probability and statistics to get better modeling of the risks of our cash flows and our discount rates. So if we take a simple two cash flow bond example, say cash flow 2 is, in this case, estimated to follow a Bernoulli distribution. That's a yes-no distribution, distributed something like this, a 90% probability that we're going to get the as-promised cash flow 2 of 100, and a 10% probability that we're going to get 0 if the managers of the company screw up, right? And so this would give us an expected value return if we repeated this experiment many, many times of 90. But if we use the whole Bernoulli distribution to model the risks of this bonds, we can say more to our clients than we've been able to before. Previously, we've been able to say something like our best guess is that on average, if we do buy a lot of bonds like this, on average, we're going to get $90 a bond. But now, knowing the whole probability distribution, we can also say, and we're going to sound oh so smart, this is based on our view that about 90 out of 100 of these projects will pay their promised cash flows, contractual cash flows of 100, but we think about 10% of them are going to flame out. And when that happens, in bankruptcy, we're going to get a cash flow 2 of 0. So you see, doing this, thinking about the whole probability distribution, it just gives us oh so much more to say and honestly oh so much more to know about what's happening. Okay, so how did we do this? We're still using our point statistic, which is our expected value. We'll think of this as our general case reward. So our point statistic will be expected value, general case reward, and we're going to be always using the spread of our probability distributions to measure risk. And with a Bernoulli distribution, the spread is just the worst possible outcome and the best possible outcome. So we need to think a little bit about cash flows versus returns here. And if we're looking at any project with future cash flows, so let's say we have a cash flow here at t equals 0 and a future cash flow here at time t equal 1. Cash flow 1 is clearly a random variable. It's out in the future. It hasn't happened yet. It may or may not happen in part or in full. So we're going to measure that with a probability distribution, Bernoulli or normal or otherwise. Also, we're going to be looking at, in just a second here, returns for projects, and returns are defined in one of two ways. If we're talking all cash flows all the time, cash flow 1 minus cash flow 0 divided by cash flow 0, and since cash flow 1 is a random variables in, random variables out, return is going to be a random variable too. Also, a lot of times, if we are stock investors or something like that, and we want to think about what's our return of owning the spiders after a year, we estimate the price of the spiders in a year, whether or not we're going to sell. We just sort of pretend we're going to sell at the price we anticipate in a year, minus the price today divided by price today. And since price in the year ahead hasn't happened yet, that's in the future, that's a random variable, so the return is still a random variable. So we need to be able to think about future cash flows and returns as random variables with probability distributions. And we spent some time going over modeling the reward and risk of stock returns. This example I've included again because it's extremely important. So let's just go through it because conceptually this is really foundational. So we've got here the project is to buy 1 share of the spiders, hold for a year, and sell. And what we're interested in is how to characterize the returns for this project probabilistically and statistically in terms of reward and risk. And return is going to be for this project price a year out minus price now quantity divided by price now. And how did we go about doing that? Well, we started by looking at history, and we do this a lot. It's not great, but it's what we have, and so it's very common. And so I got a bunch of end-of-year closing prices of the spiders. These are available. You can pick these up very easily. These are at Yahoo Finance, Bloomberg, Google Finance, etc. And from the prices, I computed an annual return for each year. So now I have a big list of returns. And then you want to do a probabilistic statistical analysis on this return data. And this is something you want to do with any statistical probabilistic problem that you have. First thing you really want to do is create a frequency distribution of your data and just see what that looks like. So this is actually real data, and this is what it looks like. And what we typically say in a case like this is that, well, you know what, it's got a central tendency here somewhere around the mean. It's spreading out this way, spreading out this way. It's sort of kind of symmetric. So we say, hey, it's got shape of normal distribution, okay? And so that's step number 1. And then step number 2 is you always want to compute some key statistics for your sample data. Always want to get your average return. And when we're talking about sample data, that's X bar. So I did that for the above data. It's 8%. Standard deviation of the sample data, that's always called capital S, was 25% there. Okay, but now with this assumption saying, hey, yeah, this kind of looks like normal, and these sample statistics, we can make a huge jump. Okay, and that's what we do. We say that on the one hand, the future of the spiders is going to look like the past, and on the other hand, we'll say since that sample data looked kind of normally distributed, we'll say we can model it with the normal density function. And so we morph our sample expected value into the expected value of the normal distribution, and same thing with the standard deviation of returns. And so we've gone from something, our real data, the truth and nothing, the whole truth and nothing but the truth, to this, okay, which is our normal distribution model. And to get there, we had to say, first of all, well, future returns, if we get a whole bunch of future returns, they're going to look like these past returns. And then we had to say, this looks normal, and we can morph this sample expected value and standard deviation into the same statistics for the normal distribution. So that's everything that's behind so much of what we do in finance when we're looking at returns of stocks and things like that. Okay, so the 2 big implications of this is that we're measuring reward by expected value still here. We're saying we characterize reward by, on average, over the long haul, we expect the spiders to return about 8% annually. But now we're also, very importantly, talking about risk, and risk is always going to be measured in some way by the spread of that distribution here, okay? So if we have something like a treasury, we assume the federal government never goes bankrupt. Our treasury return has no spread, okay? Basically what the treasury promises is what we're going to get. And if we look at something like high yield bonds, most of them turn out to be pretty good, right? But some of them flame out, and we do, to account for that, we get a higher expected value here. And if we look over here at investment B, this might be something like stocks, which on average do better than bonds, high yield bonds or treasuries, but we can lose a lot of money with those stocks. So we're always going to look at the spread as well as the expected value, and always more spread equals more risk. And then we spent a little bit of time talking about upside and downside risk, and we said that with the normal distribution, we've got something like this, but in the real world, we may have something like this. This would be a portfolio of the spiders and some puts, which would help mitigate our downside. So the good way to measure risk is to look at this left tail, everything in blue over here. Why? Because we care more about our downside losses here than anything else, right? Unless you don't care about losing all your money, which is very rare. So if we look at our left side distribution, where it's always going to work whether we have a symmetrically distributed set of returns or not, if we have a portfolio with some puts in it or something. So what are our measures of downside risk? Really anything you can think of that makes sense. Something like the probability that our return will be less than zero. I've worked with companies where the probability, we want to check the probability that we're going to lose $20,000 or more on this project, because if we lose $20,000 or more, the startup company is going bankrupt, something like that. Also, we did look a lot, and we do in further chapters, at value at risk. And value at risk is that quantity X where there's a 5% probability at return will be less than or equal to X. And any other or less or worse measures we could think about. We talked a little bit about volatility drag. Volatility drag was important for us whenever we're looking at holding investments over multiple compound periods. So we're not buying, holding for a year and selling. We're buying and we're holding for 5 years and selling. And whenever we are doing that, we want to measure our performance not by the average annual return, but by the growth of the investment over the life of the project. And we looked at a very simple but very telling example of that. So let's say, and this actually comes from a real world example, kind of simplified, you want to invest some money now for your child's college expenses in 5 years, and you're considering 2 ETFs, which one is best? And if you just thought, hey, all I really care about here is my average return, and B is clearly better, it's got a higher average return, that would be so wrong. And the reason is because the volatility of B is going to hurt you. So what you really want to look at is the value of A versus the value of B. So we start out with each one with 100,000, and then A just grows, we get that 3% return. B goes down because it has a minus 15% return. So we're left with 85,000 at the end of year one, and et cetera, et cetera, et cetera. And we just keep measuring how much money is in our account for our kids' education at the end of the year. And you can see that slow and steady wins the race here with A, because it doesn't have any volatility. The pile of money we end up with at the end of the day with A is bigger, okay? And you might want to measure with something like this the total return, which would be the pile of money you wind up with minus the pile of money you started with, quantity divided by the pile of money you started with. And you can see using that measure, A is clearly better than B. Why? Because it's got less volatility as measured by standard deviation, less volatility drag. And we looked at a graph of this, which illustrates really well what's going on. Because of this volatility, we're being dragged down with the B investment, and we just can't catch up. We just don't have time to catch up. And the other thing that was interesting about this is that the total project return, that 5-year project return, is completely path dependent. If we reverse the sequence of years, then B would have looked better than A. So to analyze these volatility drag carefully, we have to use methods beyond the scope of this class called Monte Carlo simulation. Okay, so that was pretty much what we covered in 13a. And then in 13b, we expanded on that. We sort of built our foundation in 13a, and we started with a reminder of when we get these higher rewards, these higher expected values in our investments, they always come with more spread, which means more risk. So what do we want to do? What's a poor investment manager or hedge fund manager or CFO who's got funds to invest. What are we supposed to do with this situation? One thing that we could do is we could just say, hey, we're just going to invest in projects with very little volatility drag. So that's going to give us, unfortunately, if we do that, very small expected value return. And sometimes we need to do better than that despite the risk. So another thing we could do, which would be way super cool, is we could invest in a diversified portfolio of projects, a portfolio of projects that are poorly correlated to each other. And the incredible thing about this is this will reduce the volatility and the volatility drag of our total portfolio return, but will not reduce the expected value. As long as we really do have a bunch of poorly correlated assets and the correlations don't change in time. And this is what many people call, and I think with good reason, finance's one true free lunch. So this is a case where if it looks too good to be true, maybe it actually isn't too good to be true. Okay, so why is this so important to have a diversified portfolio of stuff? This is the super important graph that explains it. If we look at number of assets in our portfolio, number of projects in our portfolio, and we measure risk by sigma, VAR, etc., doesn't really matter. As long as we keep adding into our basket of eggs that are poorly correlated to each other, the more eggs we have, the less standard deviation, the less value at risk we're going to have in the overall portfolio, and that comes down to once we get to about 30 or so assets in our portfolio, it's sort of asymptotically leveling off here. So this is why investing in a diversified portfolio is so helpful and all that stuff. So we're going to use correlations for this really big, important reason. And we're also in this chapter going to use correlations to understand how an individual stock's returns compare to the returns of the overall stock market. And we looked at some mathematical measures of correlation. The first one was the correlation coefficient. You definitely need to know what the correlation coefficient is and how it works. So it's measuring how much two random variables tend to move together, ignoring amplitude effects. You don't have to worry about these formulas. If you wanted to compute the correlation between returns of, say, the spiders and Intel over 30 years, you could use this formula and it would work great. But I'm not going to ask you to do that. What you do need to know is this. For two assets that are very highly correlated, they're moving essentially identically, so the return of one is 10%, the return of the other one is more or less 10% in the same year. When they move identically, they'll have a correlation coefficient of 1. If they're moving opposite to each other, okay, then you're going to have a correlation coefficient of -1. And if you just absolutely cannot predict what's going to happen with one from the other one, you get a correlation coefficient of 0. And I showed you some actually reasonable real-world examples of how you could get these correlation coefficients. And then here are some graphs of them, and in these graphs, the row xy, or correlation coefficient, is called R. So here's highly negative with -0.9, and here's negative, but you see it's more scattered, so it's -0.5, and that has to do with it being scattered. And if you look at this, clearly you can see here, if we know the return of x, looking at these dots, there's no possible way we can predict what's going on with y. We can draw a line through this and make kind of reasonable prediction, and we can draw a line through this and make a really good prediction of what's going to happen with y based on x, but we can't do it here. So here's a loosely positively correlated with correlation coefficient of 50%, 90%, and 1 would be just perfect. Okay, our second measure of correlation is beta, and beta, you definitely need to know what beta is also. Beta is measuring how much two random variables move together, including the amplitude effect differences. Okay, so let me just highlight that. And beta comes, there are two ways to get beta. The most common way is from a linear regression, and it works just like this. So let's say we are interested in comparing our ETFY to the returns of ETFX. We try to make a linear regression line between y and x, y equals alpha plus beta times x plus error, and we use our standard square error technique to minimize the error term, and then beta is the slope of the line. So here we go. Here's our regression, and here's our line. Beta is the slope of that line. So I've done a regression for y2x for this data, these 4 points, and you can see the diamonds here are my 4 actual points, and the line and the orange squares are the best line fit line we could fit through there. And what are the characteristics of the line? They come from the regression. So the intercept down here, a little bit negative, and the slope is 1.6, and the R squared is 98. That means that 98% of the performance of Y can be predicted by what's going on with X. So that's a really good regression. And the graphs for beta look very similar to rho, positive, negative, and here if we just cannot tell what's going on with y from x, beta, like rho, would be equal to 0. All right, so there's also a formula for beta. If we know rho, this might be a good thing to know for the final, that beta b to a is equal to rho ab times sigma b divided by sigma a. So you don't need to do a full-blown regression to get beta from that. You just need to know the correlation coefficient. Okay, and then we used this graph here to show you what we mean by rho not including any amplitude effects and beta including those effects. So A is the blue line here, everything else is relative to A. So for B, we have, even though the amplitude is twice of A, its correlation coefficient is 1. It gets maxed out at 1. C is exactly opposite A, so we get -1. D is exactly opposite A, but with twice the amplitude, and it's maxed out again at 1. Beta, on the other hand, if we look at the beta of B to A, we have 2, which includes that amplitude effect, that the returns of B are always twice as much in absolute value as the returns of A. And we see the same thing over here with D. D is completely negatively correlated to A, but with double the amplitude, we get that in beta, we don't get that in rho. So beta is really giving us more information, okay? And I think everything that's said there, we just talked about. Okay, so let's keep going. So we've got our 2 uses for beta and rho. Number 1 is building diversified investment portfolios. So what do we mean by that? So you're a portfolio manager in a company, for a hedge fund, for a mutual fund. Define your mission, build a portfolio of mission-fitting investments, and you want to do that. They've got to be mission-fitting, so they've got to be in the right industry and all that jazz, but you want to find ones that have big differences in beta and or rho, and then you've got your diversified portfolio. So that's really cool. So the problem with this is, as always with our models, they're not so great, right? Our models are really not so great in finance. It's a bummer, but it's a fact on the ground. Okay, so what's wrong with this picture? Are correlations static? No, unfortunately. Just when you don't want this to happen, the correlation coefficient between everything and everything else goes to 1, and that typically happens in recessions and depressions. So that's bad. Does the future look like the past? We've talked about this a lot. Generally, often it does not. Sometimes it does, but often it does not. Okay. And also this model saying the only smart way to invest, and this is really how it's characterized a lot, in finance is smart investors always invest in diversified portfolios. So what's that telling entrepreneurs? It's telling them you're stupid. You're putting all your eggs in one basket. You shouldn't be starting a new company. You should be investing in a diversified portfolio of existing companies. Okay, and this is good to know because we do want to quantitatively be able to build not a diversified portfolio of 30 assets, which is a little bit beyond the scope of this course, but how about a portfolio of 2 or 3 different things? So we get the expected value return of our portfolio is just the x's are the weights. So x's are, oh, what happened there? The x's are the weights, so the expected value return of our portfolio is just the weighted average of the expected value of the components of the portfolio, and the variance of our portfolio follows this formula. It's not really that hairy. Just write everything in carefully and then be careful to make sure you remember that that formula is for the variance and the standard deviation is always the square root of the variance. So you might be wondering right now, why does he have a star there? Is he asleep at the switch again? Well, I might still be asleep at the switch, but I do have something to say about this. Okay, this formula is correct. There is a typo in the class notes formula. Okay, in particular, so this formula is correct. I noticed there's a typo in the class notes formula. One of the one of the indexes is incorrect in the class notes. Yeah, that's all I'll say about that. But this formula is correct. There's a mistake, I think, in this term. It says sigma 1 squared here when it should be sigma 2 squared. Minor typo, but I just want to make sure I caught it for you here. So this version of the formula is correct. And I've spent so much time on this, you kind of might want to expect that you'll have to use this on the final exam. Okay, so the second thing that we use beta and rho for is to help understand how the returns of an individual investment compare to the overall market. And mostly, honestly, we use our regression with beta, and we're also going to include alpha for this. So how do we compare an individual ETF or stock or something like that to the market? Well, we go out and we get our bunch of historical returns for our market proxy, which is typically going to be the SPY ETF or something like that, and then get a similar list of historical returns for our prospective stock or ETF. And then we do want to go ahead and perform our linear regression of the ETF or the stock we're interested in versus the stock market. So you always want to put your stock market on the x-axis there and look at the returns of our prospective stock or ETF on the y-axis. And we're going to get something like the red line here, where the slope is going to be beta from the linear regression and the intercept is alpha. Also, it's important to note here, there is this thing called the market line. If we regressed the market to the market to itself, the regression line we would get would be this line with an intercept of 0 and a 45-degree slope or a beta of 1. That's called the market line. Okay, let's think about this regression that we've done to compare our individual stock to the market. So if our individual stock behaves just like the market, it's going to look like the market line regression, beta equals 1, 45-degree slope, intercept at 0, alpha equals 0. So let's look at some more interesting cases. If we have, like we have over here, a slope of less than 1 here, that is our beta less than 1, and that corresponds to less than a 45-degree slope. And what that means is that our prospect stock is less volatile than the market. And that's important because it tells us less volatility drag, less risky than the market. So it might be okay to have a lower average annual return there. And if, on the other hand, when we do our regression, we get a beta that's greater than 1, it's telling us our prospective stock or ETF is more volatile than the market. We have more volatility drag, so we're going to overcome that. There's nothing wrong with that, but to overcome that, we want to have a higher expected value. Okay, and now let's think about our intercept, which is equal to alpha. The way to interpret the intercept, this is actually very important too, is that it's the return that we expect on average when the market return is 0. And you can see that right here. The market is returning 0 and we're getting alpha, and that's way super cool. So when alpha is greater than 0, alpha is the excess return over the market. And we talked a lot about investors who focus on that, and let me go over that a little more here. Alpha-focused investors are always looking for a high alpha. Okay, so when the market's not doing anything, they're making a lot of money, and their sort of holy grail would actually be a line like this. Whoops, if I can get the line thing here. Yeah, here we go. Would be a line like this. That no matter what the market is doing, they're making some return alpha here. So those are our alpha-focused investors. And so they want to give us a consistent return. The key here is irrespective of the market's performance. And beta-focused investors are always looking to compare themselves to the market. Okay, they're always looking for performance relative to the market. So these are the types of investors who say our benchmark is the S&P 500. That's what they're always comparing themselves to. Okay, so they might be looking to have a beta less than 0. So they'll say we want to follow the market generally, but be a little bit less risky. And they'll say we want to follow the market generally, but we want to do better when times are good, and we think we'll have a higher expected value return. But the key thing is they're comparing themselves to the market. Okay, and last little note here, risk-free securities like treasuries are assumed to have no correlation to the market, so they're going to have a beta of 0. And the last thing we talked about in this chapter is the fact that a lot of equity-focused investment firms are going to show you graphs like this and say, you know, over the long run, the pile of money that you get by investing in stocks is much bigger than the pile of money you're going to have by investing in bonds or just keeping up, putting your money in a money market and keeping up with inflation, something like that. And they'll always show you a graph like this with almost 100 years worth of data, and you can't really look at that, as John Maynard Keynes would say, if you look at the period from, say, 2000 over to 2009, you could have lost 50% of your money, not once, but twice. And if you only have a 10-year for example, investment horizon, you could lose 50% of your child's college tuition and not be able to send them to college. So it's very important also, the more volatility drag you have, the higher risk you have, the longer your investment horizon needs to be, so you have time to recover when bad things like this happen, bad things like this happen, very bad things like this happen. If you don't have a long time horizon, you should be investing in something with less volatility drag.